Time check ng'ekutuusibwako Occupe Lesabeilles Solutions Uganda Limited nga bano bakuwola ssente wamu n'okusevinga ate nga ssente zaabwe ozifuna mu bwangu ddala wakati w'ennaku 2 ku 6 ate nga naawe asevinze nabo nga tojjaayo okumala omwaka mulamba bakuweeramu amagoba aga 5% ku ssente z'oba osevinze nabo. Gw'ayagala okumanya ebisingawo batuukirire ku ofiisi zaabwe basangibwa Nansana Namusera ku Hoima Road. Bakubire ku namba 0290906590 oba bakubire ku 0393246474. Tokkiriza bafere kutwala bintu.
About microfinance. Take 6.5. Around the world, billions of people are living without access to the financial services that many of us take for granted. Without access to loans, savings accounts, insurance, and fund transfers, the obstacles to overcoming poverty or attaining financial stability can be insurmountable. There's a movement underway to provide better financial services to people that banks don't serve. These services are collectively called microfinance. One of the most powerful facets of microfinance is microcredit, or small loans. Microfinance institutions in many countries offer loans of a few $100s at a time to people in need. Sometimes, this is all it takes to help a person become profitably self-employed. Their business can provide valuable goods and services to their community, and proceeds from their business can support them and their family and allow them to pay back their loan. Loans are also sometimes used for housing, education, or to create other opportunities for people to improve their lives. Microfinance institutions can also provide savings accounts and insurance to their clients, allowing them to manage risk more effectively. If bad weather, illness, or other unforeseen events disrupt a client's business, savings or insurance can help keep their livelihood intact. While microfinance can be very successful in combating poverty, it isn't a complete solution. Other tools, such as literacy classes, investments in infrastructure, and legal reforms are also very important. Thanks for watching this introduction to microfinance. To learn more,
in many parts of the world, when you apply for a business loan at a bank, the bank is going to take down various pieces of information about you, such as your age, your name, education, and address, and input that information into a risk model to figure out if you're going to pay that money back and to gather additional information about you. Now that we live in the glorious age of artificial intelligence and machine learning, even more information can be collected about you and analyzed to figure out what makes you successful in business. That is, unless the data being collected about you has nothing to do with what really makes you successful. This would seem obvious, right? If you're going to use technology to determine the creditworthiness of a business or an individual, you should make sure that the data you're using is at least relevant by geography, culture, and demographic. And that's how it works in most of the Western world. And the result of that is the generation of wealth and prosperity. But in Africa, we have a problem. In sub-Saharan Africa, where we operate, finding the right kind of data and sourcing that data to make these decisions is incredibly difficult. Customers are thin-filed. The information is localized at a bank. It's not shared. It's not federated in a general sense like you would with a credit bureau. And those decisions are hard. In Africa, we should be competing on a global basis, but we're not. And that's because the financial institutions in our ecosystems don't have the technology or the risk models to harness the wealth potential accurately. And what I mean by that is that the traditional methods currently used to evaluate the creditworthiness and the risk profiles of these businesses completely ignore the vast differences and the cultural realities of ethnic and religious groups across the continent. And I really do think that in order for them to compete on a global scale, Africans must start to generate and transfer wealth authentically. And the only way to do that is to build our culture and our history directly into the financial ecosystem, our business, our banking, and our technology. So a few years back, when we started this journey, we noticed that the banks and the microfinance institutions who had set up shop across Africa didn't seem to be able to make a dent in the more than $300 billion business credit gap, which to us means that the companies they're supposed to be helping actually are not growing or generating wealth at all. And our gut feeling was that this is because they actually do not understand African businesses or entrepreneurs. So in 2013, I co-founded a company called Ovamba with my business partner, Marvin Cole, with the goal that we would try to figure out how to get these businesses to grow correctly. And we started by studying various tribes in Cameroon to figure out what is it that makes them successful and how do they respond to financial obligations. Now, Africa has thousands of ethnic groups and more than 2,000 different languages. And the cultural diversity and traditions make for a very complex landscape. So if you want to start talking about business and financial products, you really need a deep understanding of the nuance and the history and respect the elegance required to code for the financial products and the business environment of the vast African market. And this is why we decided to use artificial intelligence and our own proprietary technology to embed ethnic and cultural data into the risk models, algorithms, and the products that we have since developed. So here's an example. If you take an entrepreneur who goes into a microfinance institution to apply for a loan, these types of businesses are often from the informal sector. They often use their family members as employees. They don't keep a balance sheet. And they're certainly not working to a well-written business plan. And they are sometimes functionally illiterate. And by that we mean they are able to read and write, but they may not be formally educated in business. And these applicants usually get turned down by banks, and this is the reason why they go to microfinance institutions. But the microfinance institutions, when determining risk about these groups, can only really use what is at hand. Information like you look like a woman, your gender, your age, your bank account, how you deposit your capital, and collateral. Hopefully that collateral has the kind of land title that they can use for these loans. But with the model that we use, we added an additional, maybe as much as 400 additional data points. Things like language, dialect, family structure, personal and professional relationships, number of wives, and even tribe. And that's because we believe that this is the kind of information, plus some other pieces, that you truly need to understand African business risk. So what about the Hausa man who applies for a loan? Now, in his neighborhood, he has a shop. And at Eid, he sells candles. And in August and September, he's selling back-to-school items. The rest of the year, maybe small electronics. And his shop is usually always open, except for about 4 to 6 weeks when he's closed for Ramadan. Now, he can't go to a microfinance institution because most microfinance institutions actually do not carry Islamic products, the type that are non-interest bearing. And banks are going to think he's a high risk because of the changing nature of his business. So they would likely turn him down, and that would be that. But we know that that would be indeed a mistake, because we know and understand that, traditionally speaking, if he is Hausa, there is a chance he's got more than one wife. And if he does have more than one wife, it means that he's actually a very good risk for us. And he's the kind of customer that we like to fund. And that's because polygamy, which is still practiced in Africa, actually acts as a form of life insurance. It's strategic. It's a sign of wealth and stability. It is not a